Profit has become so much harder to come by in the huge US market for natural gas that some traders are buying and selling in lesser-known local pipeline hubs, where bigger risks offer the promise of better rewards. Futures contracts traded in New York are benchmarked for US prices are seeing fewer of the big price swings that traders crave because of a prolonged domestic glut. But that isn't the case in regional markets like Pennsylvania, Ohio or West Texas, where Mercuria Energy America Incorporated, Vittle Incorporated and Trafigura Trading LLC are among those increasing bets on next-day gas deliveries, data from the Federal Energy Regulatory Commission show. As gas production surged in remote shale formations in recent years, pipelines were built to carry those supplies to high-demand areas and boost shipments to Canada, Mexico and coastal plants that converted the gas to liquid for export overseas. While New York Mercantile Exchange futures remain the dominant vehicle for U.S. trading, gas flows have shifted, opening new markets. Volumes at more than 200 local hubs served by the Intercontinental Exchange Inc. have jumped 17% in the first half of 2017 from a year earlier. The shift in terms of just where the supply of gas is coming from the last 5 years has been dramatic. It's completely changed the way we buy gas. The move to local markets reflects the disruptive influence of new drilling techniques that unleashed prolific supplies of low-cost gas in shale basins from New York to North Dakota to Texas. Domestic output has surged almost 50% since 2006, government data show. With more new sources of supply, big utilities that use the fuel to heat homes and generate electricity have been forced to alter their trading plans and reverse pipeline flows. This is the largest upheaval since the market was deregulated in the 1980s. While the bulk of trading at local gas hubs still comes from utilities and others taking physical delivery of the fuel, speculators are grabbing a bigger share. Last year, 10 merchant traders represented almost 8% of the gas traded, up from 6.5% in 2015 and more than double 2012, according to Federal Energy Regulatory Commission filings. You can make money regionally because there are these inefficiencies that traders can capitalize on. The infrastructure isn't fully built out, and you are seeing northeast bottlenecks that can be identified and capitalized on. Exelon Corporation, the largest U.S. competitive energy provider, expects the increased trading at local hubs will help improve market price transparency for producers and consumers. One of this year's closely watched markets is Pennsylvania, where the startup of Energy Transfer Partner LP's Rover pipeline had been expected to boost prices for supplies in the Marcellus Shale play, the biggest U.S. gas reservoir. The gas had been selling at a discount because it couldn't be delivered into major Midwest markets. But Rover was delayed, and Goldman Sachs Group Incorporated reported losing money on its bet that prices would rise. Another popular hub is Dominion South Point, a benchmark for Marcellus and Utica gas in Pennsylvania, Ohio and West Virginia. Dominion South Point gas started trading at deeper discounts as output in Appalachia grew faster than pipelines could be built. Prices in the region fell to a record low of 29 cents per million British thermal units in September 2016 before jumping to $3.42 within 8 weeks. The 100-day volatility for Dominion South is more than 6 times greater than the New York benchmark based on Louisiana's Henry Hub, a major pipeline intersection on the Gulf Coast. The day prices fell to a record low on the local market, volume jumped to a 12-week high, data compiled by Bloomberg show. Spot trading volume at Henry Hub, meanwhile, has been hovering at the lowest levels in data going back to 2001. Gas futures in New York were down 1.5% at $3.016/million British thermal units at 2:05 p.m. In the South, record U.S. gas flows through pipelines into Mexico are making Texas hubs more expensive relative to Henry Hub. But when a massive earthquake on September the 19th slashed gas demand from Mexico's power grid, gas for next-day delivery at the Waha hub near Houston tumbled 7.3% over the following 3 days. There is a lot of repositioning and hedging around new infrastructure announcements or delays as increased shipments give local hubs their own interesting supply and demand volatility. Regional hubs are becoming a bigger part of the U.S. gas market, Based on trading on exchanges run by ICE, CME Group Incorporated, Single Quote S9X and Nasdaq Incorporated, they now account for about 10% of all trades, according to data compiled by ICE. The Henry Hub isn't going anywhere as a benchmark, but certainly from a regional standpoint, what we have seen in the past year and what we will see in the next couple of years is growth in transportation infrastructure as these markets mature. With more action on local markets, utilities are turning some of their regional gas traders into specialists and hiring more people to beef up their presence at individual hubs. Instead of focusing on the entire Southeast or Midwest, each trader might trade just one pipeline interconnect in Alabama or a Michigan city. It's granularity out of necessity. It creates a more predictable level of revenue and income. To get faster updates and the latest news from the oil and gas industry, please subscribe to the YouTube new video channel and connect with us on Facebook, Twitter or LinkedIn.